So it's almost tax time. It's the beginning of the year. I feel like literally from the beginning of January to April, most people are thinking about taxes, getting their taxes organized. So we thought a tax-themed episode would make sense.
Anytime you think about taxes going away forever, you should already know that's a myth. I tell our clients a lot of times the IRS is always going to get its pound of flesh.
We do not want to make decisions as investors exclusively for taxes, because that probably means we're not making the best investing decision for ourselves.
Yeah, and just to be clear, we mean an actual CPA, not ChatGPT.
Hello, welcome back.
Hello, so good to see you on a snowy, well, I guess it's not snowing anymore, but snow-covered day in the DC metro area.
Yeah, we're going to have snow here on the ground for definitely weeks, if not maybe a solid month. Plus, we're getting more this weekend, I heard. No.
Yeah, I heard that.
Over it. So over it. Ugh. I hope
it's enough.
It's enough. Yeah. I hope wherever you all are watching us or listening us, it is a lot warmer than it is here in the DC area. But welcome back to Living Richly with Curo. This is episode 89. My name is Ann McCabe. I am the CEO and a partner here at Curo Private Wealth. And I'm joined, as always, by my lovely partner, Atricia.
Hello, I am Atricia Roberts, COO and partner here at Curo. Thanks for coming back to our long-time Curo listeners, and then welcome to our new listeners and subscribers.
Yes, we are grateful for all of you. We realize that there are no short of, a million different things you could be doing with your time right now. So thank you so much for investing some of your time and your energy and your attention into us and this episode. We are here, if this is your first time, to inspire, empower, educate you on your financial journeys. And today's topic is about tax loss harvesting. So it's, almost tax time. It's the beginning of the year. I feel like literally from the beginning of January to April, most people are thinking about taxes, getting their taxes organized. So we thought a tax-themed episode would make sense. And if you've ever heard of the term tax loss harvesting and thought maybe it was a scam or too good to be true or a trick or even something that is reserved for the ultra, very sophisticated, wealthy investors, this episode is for you, because Atricia and I are going to be busting some myths up in here.
Which we love on this pod. We love a good myth-busting episode, so I'm excited.
Yeah, we certainly do. I feel like we need badges. We need like myth-busting badges. Quick disclaimer, because anytime we talk about anything tax related, we do have to remind you that this is not official advice. So anything we share is educational in nature. And if you think it could make sense for you, take it back to your CPA and talk with him or her about your specific situation. But again, this is not advice.
Yeah, and just to be clear, we mean an actual CPA, not ChatGPT.
Right. Thank you. Yes, ChatGPT did not pass the CFP last
time I checked. Not where you want to get tax guidance.
Yeah, exactly. All right, Atricia, so why don't we kick off, before we start busting myths, why don't we kick off with what the heck is this thing called tax loss harvesting?
Yeah, so we want to make it plain English language that we used here. And basically, when you think about tax loss harvesting, you are taking the opportunity to use an investment that has gone down in value. And I don't mean like overall value, I mean down from the value where you purchased it. And you are able to sell that investment and use the loss that you're going to recognize. So remember, you sold for less than you bought. So there you have taken a loss, and you use that loss to help offset some of the gains from other investments that you may be interested in selling while they're up or higher than the place where you bought them. So one thing to remember about it is that this only applies to what we call taxable accounts. So that means this excludes your IRA, this excludes your 401k, Roth IRAs, SEP IRAs, any account that you have where you have been deferring taxes, right? Where you don't get a regular tax document unless you've taken something out of it. That doesn't apply. So only your taxable brokerage accounts does this apply to. And again, even when you sell an investment at a loss, if there are no gains to offset in the year, there may be an opportunity to actually offset some income, which would be nice.
Yeah.
Again, the less ordinary income taxes you pay, the better we all feel at the end of the day.
Yeah. Absolutely. So, yeah, it's one of those things where it's kind of like a silver lining. Like back in actually even last year in 2025 in April, right? We all remember
Mhm.
with the Liberation Day, the liberation of your wealth, the liberation of of the stock market day.
The
um,
liberation of your gains.
liberation of your wealth. Anyway, back to that day when the S&P was down what 19%, almost 20% in a month. We at Curo, we're never excited when the market goes down. However, we put our little, tax hats on and we're like, ooh, is this an opportunity that we can harvest some losses, especially for some of our newer clients, for clients who have been around forever, not as much of an opportunity. But things like that, when you see the market go down or you know the market is going down and you have a taxable account, this is the thing we want you to start thinking about. Certainly 2022 was a huge opportunity.
Yes.
Lots of loss harvesting. That was not just a period of 30 days. That was pretty much like opportunity to harvest losses all year long.
All year. Yep.
Yes.
And it's a good way to reframe it for yourself emotionally. Nobody wants to log into their account and see red numbers, right? That things are down. But if you reframe it as an opportunity to use it for something that maybe helps you pay less to the IRS, then you reframe it emotionally.
Right, exactly. And it is the kind of thing where if you can't use all the losses in one year, you can carry them forward. So I remember we, harvested lots of losses for clients back in 2022. And then think about what happened in the markets in 23, 24, 25. We've had gangbuster markets. So we were able to use those losses in 2023, in some cases 2024. So it's something that you don't have to use that year. You can actually roll them forward and use them for gains in the future. So very powerful. All right, let's start busting some myths. Myth number one, this is a strategy that is only reserved for the ultra wealthy or ultra sophisticated. Eh.
Eh.
I wonder why people think this. And I believe it's because, Wall Street likes to use a lot of fancy technical jargon, likes to make you think that you're not smart or that you don't understand or that these strategies are so complex that no human who doesn't have the professional knowledge that we have could do it. But the reality is all you need is a taxable account, like Atricia mentioned. So this is not for your retirement accounts. You just need a taxable account and you need some investments that you have purchased, that you have invested in that have gone down. Now, we'll talk in a moment about how we don't want you to be doing this every time an investment is down $20, right? So there has to be some thought and some scalability around it, but it doesn't need to be complicated. And one of the stories or one of the examples we wanted to share with you is we recently onboarded a new client. She received an inheritance from her mother who passed away. And this is a client who hadn't previously had a lot in taxable investments. She was funding a retirement plan, but she didn't have a lot of investments outside. And I'm not going to get into the technicalities of the inheritance, but the way the inheritance worked is that some of the investments that she inherited had been owned for many years and had really big gains. And then some of the inheritance that she received had lower gains. And so we were actually able to go position by position. We were able to sell some of her investments that had losses on paper. So they had gone down from the time she inherited them, and we were able to use those losses to offset selling some of the investments that had been in the family for many years and that had big gains, but we needed to diversify. So we were really able to pick and choose which of the positions had losses or had less of the gains, sold those and used those to offset. And by the way, this is going to be like a multi-year process. I was telling Teresa one of the positions that she owns is up like over 700%. So we're not getting rid of it, overnight. It's going to be a process. But we were at least able to start because she had some investments with losses and some investments with much smaller gains. So that's a real life example of someone. This is not, somebody who's a billionaire. She received an inheritance from her mom and wants to live a great life, but also really wants to be smart about investing. And this was something that we were able to do with her, that we are doing
Yeah.
ongoing.
Yeah, and just a little plug, and we love to remind you, it pays to work with someone who knows what they're doing. So, whether it's at Curo or
Yeah.
anywhere else, working with an experienced advisor can save you thousands of dollars over the course of your investing life. It's well worth the expense.
Yes. Amen.
Yeah, but extra plug for Curo. We love to work with you.
We would. We would.
Okay,
We're kind of cool.
we're pretty special. All right, so let's bust another myth. So, myth number two is that tax loss harvesting makes taxes disappear forever. And I mean, anytime you think about taxes going away forever, you should already know that's a myth. I tell our clients a lot of times the IRS is always going to get its pound of flesh. It may not be now, but they will get it. So, the reality of the situation is that harvesting losses, typically you think of it as a deferring of taxes, right? Not a erasure of taxes. Many times when we do a tax loss harvesting strategy, and we'll talk about this in a little bit when we bust another myth, is that we're not just selling the investment to get out of investments altogether, right? Usually you're selling something that has a loss to harvest it, but then you're reinvesting the proceeds into something else. And anytime you buy into another investment, there's always an opportunity for that investment to grow. That's the entire idea of the concept. So it doesn't mean that you're never going to have more gains. The idea is that you're able to use those losses to help offset in your current tax year. And like Ann just mentioned, possibly roll forward to future years. So think about it as like loss now versus gain later. And we're trying to just smooth out, right, your tax ride over time. So think about it as your tool for managing timing and impact and not waving a magic wand over all of your tax situation.
Yeah. If anybody tries to pitch you a magic wand for not paying taxes, run in the opposite direction
Please,
because
please,
red
please.
flags. Red flags. Okay, myth number 3, you should harvest every dip or every decline in the market. That is not true. We mentioned this a moment ago, but you have to remember anytime you're harvesting losses, by definition, you are selling an investment. And as Atricia just mentioned, hopefully turning around and buying another investment. And so depending on the cost structure of your investment account, because there are lots of different ways that you can pay for this, but depending upon the cost, there could be additional costs for trading. So if an investment is down, you know, a fraction of a percent or 20 or $50, you probably don't want to hop on this strategy. So typically, as just to give you a sense of a number, I would say we'll look at a position with a minimum of $1,000 loss before we even think about harvesting again because of the trading. And we don't want to get too far away from your asset allocation, your long term plan. So, what we do want to do is be selective. As I mentioned, maybe you come up with a dollar amount for yourself. So, if an investment goes down more than X dollars or more than X percent, then you will consider harvesting that loss. But what's something that is extremely important, and I feel like we coach our clients about this all the time, especially our clients who are very tax sensitive. We are extremely tax sensitive, but as long term, smart, savvy investors, we always want to make the smartest investing decisions first. And then we want to be tax sensitive, not in the opposite direction. So there's a fantastic saying in our industry: do not let the tax tail wag the investment dog. I have to slow down and make sure I say that properly. But we don't want the tax tail wagging the investing dog. And all that means is we start with the investment strategy, we make sound, smart investment decisions, and then we are also sensitive to taxes. We do not want to make decisions as investors exclusively for taxes because that probably means we're not making the best investing decision for ourselves.
Yeah, exactly. And I'll share just one quick example of a real life client where we are managing a fully diversified portfolio for them. And I think we've talked a little bit on the pod about our investment committee and how we approach investment decisions. But the client reached out and said, "Hey, there's a position in this portfolio that is down. Should we sell it and take the loss and, and do something else with the money?" And so I had to go back and remind him that this position plays a role, right, in the portfolio. It was decided upon thoughtfully. And just because there's a slight loss or unrecognized loss on it now doesn't mean that we don't believe that it'll come back or it won't behave in the way that we ask it to or expect it to. So again, just want to double click on Anne's point is that you don't just make the decisions around your investment strategy just solely based on the taxes.
Exactly. Great example.
Yep. Okay, so now myth number 4. If I sell, I should just sit in cash. Okay, we've been hinting at this one
Yes.
for a little bit now, but we have always reiterated here that staying invested matters, right? We always say it's not timing, TIMING, the market, it's time in, TIME space IN, the market. And so we want to remember that when we're working on tax loss harvesting strategies as well. So a typical approach to this is that you will sell the investment at a loss and then you buy a similar, not identical, that matters, and we'll explain why shortly, a similar investment so that you keep the money working. So we're not just selling things and sitting in cash. We're actually finding a similar investment that maintains a same tactical approach in your investment strategy that we can reinvest those proceeds in so that you're not just selling out of the market for the sake of taxes. You're staying invested and also taking advantage of the strategy. So listen, it feels good to say, okay, we'll just go to cash and we'll wait, right? We love that, especially in this interest rate environment. I always remind clients that we've gotten really spoiled in the last 5 years with the yields that we've been getting on cash. But it wasn't that long ago when most of our savings accounts were paying 0.1%. Okay, so going to cash right now feels very safe. But we've talked about this before is that the days out of the market can have a significant impact on your overall portfolio performance. So we want to make sure we stick to that strategy, we stay in the market, and that's why we find similar investments to reinvest our harvested sale proceeds into.
Yes. And that actually ties really nicely into myth number 5, which is the wash sale ruins everything. So what Atricia was just talking about is exactly that wash sale rule. So here's what the IRS says. You may not sell an investment and turn around and immediately buy the same investment back and take that loss. That is called the wash sale rule. So for example, let's say I own Apple stock and it has declined and I sell Apple stock today, I cannot buy Apple stock back tomorrow and take that loss because I bought and sold the exact same identical position. However, let's say I have Apple inside of a diversified exchange traded fund or mutual fund, and that position has a loss. I can sell that ETF or exchange traded fund, take the loss, turn around and invest in something similar. Maybe that new ETF also has Apple, but guess what? It has a lot of other positions as well. That does work. So that the IRS allows because it is a different investment from the one that you sold. So here is where, and Atricia mentioned this earlier, it is crucial for you to work with a professional, work with your CPA, work with your advisor to make sure that you are doing this properly. And as Atricia said, paying someone like us as professionals to help you with this will save you. God forbid the IRS comes after you to audit you because you did this strategy wrong, right? So really, really important that you work with your professionals, your team to make sure that you're executing this properly. And also that way you don't have to keep up with all of the rules and how the IRS sees this. And also if rules change in the future, because they do, right? The laws and taxes certainly change. So make sure that you're coordinating with your team to implement this strategy if you do decide to do so.
Yeah, and just a note because Anne mentioned exchange traded funds, there are several investment companies that offer mostly the exact same exchange traded fund, just with a different symbol. So you want to be mindful of those two, that they might actually be a little bit more identical than you realize. So just because you bought the S&P ETF at Fidelity doesn't mean that it's necessarily dissimilar enough from iShares S&P 500 fund. So you just want to make sure you're working with people who understand the difference and can help make good solid recommendations for you.
Yes. Very important point. Thank you so much for bringing that up. Just because it's a different
Yeah,
name does not mean it's
right. Doesn't mean it's a
not the
different
exact
fund.
same thing. Yeah.
For sure. Okay, so now myth number 6, if I'm not tax loss harvesting, I'm doing it wrong. Ain't. Again, when we bring you these kinds of tips, these are educational moments. We are trying to offer you tools. They're not requirements. So we don't want anybody to listen to this episode and think, oh my God, I haven't been doing this. I've been doing everything wrong, or I don't know what I'm doing. It's also necessary to acknowledge that sometimes it's not appropriate. Right. So we talked a little bit earlier, like you don't want to be doing this, a lot of trading activity if it's going to be expensive in trading fees. And then sometimes it doesn't move the needle a ton, right? So you think, oh, something is down. Oh, I've got a $50 loss. Let me sell it. And now you're running the risk of a wash sale rule violation or doing something wrong. So you can harvest $50 of losses. So that's why Ann mentioned oftentimes we think of like a minimum requirement before we even consider a position for tax loss harvesting. So just know that even if you're not doing it, it's not that you're doing something wrong. These are all tools and strategies that we can use just to help improve our situations. And it doesn't mean that every year is going to be something that's appropriate for you. So just keep that in mind.
Yeah. Absolutely. So are there any other we've shared a couple examples of real
Mhm.
life client situations. Any other examples you want to share before we talk about kind of some things to remember?
Yeah, I'll just offer one example because I think it speaks to the situation that we see a lot with the women in transition clients that we work with here at Curo, and shared an example of her client who had an inheritance from a parent. I also have worked with a client who recently had a spouse that passed away and they owned lots of assets jointly. So when Anne mentioned about the step up in basis on the date of inheritance, for many married couples, when one partner passes away, only a percentage of the assets will actually receive that step up because obviously one owner is still living. But it could be a really good tool to start harvesting the losses, if available, on those stepped up positions, especially in the 2 years of the transition. So, in the last year, where the surviving partner will still be able to file married filing jointly, but then also in the following year, and this is in the case where you may not be able to claim head of household because they're not young children in the home or qualified widow status. But sometimes older widows go into a single filer tax status in that following year. And as any person who has separated in a marriage or lost a spouse will tell you, it is a huge difference in the tax situation just based on the amount of deductions you can take, the break points you get on income. So, using that strategy to harvest loss when you receive that partial step up from the loss of a spouse is really important to help navigating that tax situation transition because it can be pretty jarring. The first year you have to file single when you've been filing married for, in her case, decades.
Yes. Yes. I can attest, having gone through a divorce the first year that I filed. I am able to file head of household because of my kids, but
Yeah.
I went from married filing jointly with those nice big ranges of income on the tax brackets to head of household. It was quite jarring when I got my final number from my CPA. I was like, "What on earth?" So,
What just
that's
happened?
what just happened. It makes a big difference for sure. So,
Yeah,
thank you for sharing that.
of course.
All right. So, anytime we talk about these sort of strategies, technical strategies, we always just like to remind you about our approach at Curo. And whether you're working with us or you're working with another advisor or considering it, it's really important, instead of starting with a strategy like this, to really start high level with your financial plan and your life goals And then we want to layer in some of these tax and investing strategies that we talk about here on the podcast. So we want you to use these strategies in the context of your broader plan, but we really always want to start with what is that? What is your plan that you are working? Where are you going? And how do we best get you there? And again, a friendly reminder to make sure that when we're talking about things like taxes that you're coordinating not only with your financial advisor but also with your tax professional. And we like to call ourselves the quarterback of our clients' financial lives because we get to see their entire financial position. So we love to work very closely with their CPAs and their attorneys and really make sure that it's a cohesive plan, that we're all rowing the boat in the same direction for them. So if this is something that has felt overwhelming or you've heard about these sorts of strategies and you don't really know where to turn, we're happy to have an initial call with you and chat with you to see if we would be a good fit. So let us know if we can support you, but you're not alone. And we are here to help you navigate all the complexities of our financial lives.
Yeah. And just remember, taxes are complicated, right? So even the bill that passed last year is what 700 plus pages long.
Yeah.
It's always complicated.
Yeah.
So don't beat yourself up if you don't get it or if you miss something or if you don't understand. I feel like they do that purposely. I think it's
It's by
intentionally
design,
confusing.
100%, 100% by design.
Yeah, so working with professionals will make all the difference if you are someone who feels overwhelmed, especially about taxes.
Yeah, exactly. All right, Atricia, let's go to our closing thought. What do we have today for a closing thought?
Yeah, I struggled with the closing thought today, but I eventually just kind of landed on another point that I've been working on for myself. So I shared a few weeks ago when Ann and I announced our word of the year that my word was vessel. And it was a reminder to take care of myself emotionally, understanding that I can't give from a place of emptiness. So, one of the things that I've been doing is sort of assessing what kind of things hurt my vessel and things that I did last year that were not making me feel as great vessel wise. And the one of the things that I came up with is that I very often overbook and overcommit myself, which is strange to me because I am a unpartnered, no children. You would think I would have all this free time, but I think having all that free time means that it makes it very difficult for me to say, no, I can't do a thing. Like there's no excuse, right? People with kids say, no, I can't do that after work because I have to do this with the kids. But when you're got a lot of time, I find that I say, oh yeah, I can do that. Oh yeah, I'll hop on that call. Oh yeah, I'll take care of that. Not just at work, even in my personal life. Like I think I shared with our team on Monday that, I've taken on a lot of responsibility in my local sorority chapter and I'm just like, this is why I think I always feel so stretched is that I often overbook and overcommit. So, in an effort to do it different in 2026, I am making sure that I allow myself the freedom to say no, that just because I don't have another commitment or because I'm free, then it's okay to just say, no, I'm not available because that's my time. Right. And not feel guilty about turning down an offer because I didn't have anything planned. So yeah, I can do the thing you need me to do. So just something that I've been coming to terms with. I'm sure that there are a lot of other people that feel that way, overbooked and overcommitted. But I realize a lot of the times I'm doing it to myself. So I'm trying to be very mindful of that this year and turning down some invitations. It's okay to say, no, I can't make it. That's
Yeah.
okay.
Yeah, absolutely. And this idea that you have to have like a valid excuse or an excuse
Right.
that like is valid to somebody else, like no, your valid excuse is you want to take care of your vessel and you want to prioritize your
Yeah.
vessel and you need rest and recovery and things that are important to you. So, yeah, I think this idea that we have to have like some sort of whatever, a kid excuse or a work excuse, like no, it can just be like I'm prioritizing my well-being and I want to make sure that I get enough rest this weekend or, that's
Right.
totally valid.
Yeah. Or
Or
even
guess
just,
or even
"No, I
just
don't want
no,
to."
or even just no, period.
No is a
No is
complete
a
sentence,
complete
right?
sentence. Exactly.
Just no. So, yeah, so I've struggled with that in the past, and that means my weekends end up packed and busy, and then, of course, work is always busy, and there just never feels like there's enough time or space.
Yeah.
So prioritizing that this year and saying no
Yeah.
sometimes.
Yeah. I love that. So mine actually ties in really nicely with that because my closing thought of today is about backwards planning. And so, when you think of backwards planning, like just simple examples is, my kids have a hockey game at 9 o'clock in the morning. They have to get to the rink an hour early. So that's 8 o'clock. It takes us 15 minutes to get to the rink. So that's 7:45. They need 30 minutes to get ready. So that's kind of the backwards planning that I think most people think about. But what I've tried to do this year is actually backwards plan my year. So starting with the goal that I want to try to accomplish by the end of the year, and then chunking it up into bite-sized pieces. So we've talked about this before, taking a really big goal and making it more digestible in smaller pieces, but also making sure that I'm actually putting time on the calendar for all of the big things that I want to be able to accomplish this year. So, Atricia, you saw some meeting invites come in for me for
Rapid
November.
fire, rapid fire. And then I pull it up. I'm like, wait, this is not till the fourth quarter.
Oh, I planned something for us in the first week of 2027. So
I saw.
I am like hot backwards planning right now. But the way that our calendars work, and we both know this
Yes,
very well, is if it does not get in, it will be filled with other things. And so to your point about prioritizing your vessel and, making sure that we have time to do the things that we need to do to work on the business, to execute our,
right.
strategic vision and our mission, we have to make sure that there is time. And so, yeah, I went a little bit buck wild with my backwards planning this week. I was like, Atrice is going to think I'm crazy booking things in November. But you know what? November will be here before you know it. And if we
Listen,
don't get it blocked, then we'll be like, crap, we can't do this until December because we already have meetings on the calendar. So,
yeah. What's the scientific statement? Nature abhors a vacuum. Our calendar abhors a vacuum. If
oh,
there is
yeah,
a space, something inevitably will fill it every
exactly.
single time. So while I was a little shocked to see the 2027 invite, I get it.
When it comes to January, you'll be like, "All right, I'm glad
Yeah,
we did
glad
that.
we did that.
Glad we did that." Yeah, exactly. So that's my closing thought of the day. And again, I think this does dovetail really nicely into what you were talking about because, for you and your vessel, like it could be putting things on your calendar like self-care or whatnot. And so you look at
Right,
your calendar and you actually do have a commitment. It may not be like showing up somewhere, but it may just be
right.
doing a workout or doing a run or going for a
Yeah.
massage or whatever. So I think if we don't have those things in the calendar, then we can easily think it's free time and then we're not making time for the things that are important to us. So I think it like ties really nicely together
Yeah, no.
with your
Yep, great.
closing
We were
thought.
on the same wavelength today.
Not surprising. Not surprising at all. So awesome. Well, thank you all so much again for tuning in to another episode of Living Richly with Curo. We love spending time with you. We will see you back here in a couple of weeks, in a couple of
Hey,
Tuesdays. And until then,
live richly.
thanks again for tuning in. If you enjoyed today's episode, please be sure to subscribe and share it with someone who might benefit from it. Friendly reminder that this is for informational purposes only. For additional information, please visit us at www.curoprivatewealth.com. Until next time, live richly.